Today, we begin a forensic examination of Intuitive Surgical. We are not merely looking at a company, but at a paradigm. Our analysis will deconstruct the architecture of what we term the digital fortress, a structure built around the modern operating room. We will probe its foundations, assess its defenses, and audit the value contained within. To comprehend the scale of this shift, one must consider a historical analog, the transition from sail to steam. The sailing ship, a marvel of its time, was nonetheless subject to the vagaries of nature. The steamship, by contrast, imposed its own will upon the environment. This is the leap from traditional open surgery to robotic-assisted procedures. It is not an incremental improvement, but a fundamental reordering of capability that transcends the inherent limitations of human physiology, like tremor and fatigue. This language, from the company's own 10K filing, is telling. A fundamentally new way. This is not the description of a better medical device. It is the charter for a new digital ecosystem within the surgical suite, an environment the company has methodically constructed for more than 2 decades. Our analysis will proceed in a structured manner. First, we will examine the genesis of this new age of surgery. We will then dissect the company's most formidable competitive defense, the moat of muscle memory. From there, we will analyze the financial architecture of the fortress and conduct a quantitative audit to determine its intrinsic value. Finally, we will assess the emerging threats at the gates and project a range of future scenarios. The foundation was laid in the late 1990s, built upon a simple observation. The human hand, for all its dexterity, is an imperfect surgical tool. It is subject to tremor, fatigue, and physical constraints in confined anatomical spaces. The central thesis was that a robotic intermediary could filter out these imperfections, granting the surgeon a level of precision and control previously unattainable. This was the insight that led to the Da Vinci surgical system. Let us now turn to the company's competitive defenses. While patents provide a temporary barrier, Intuitive's true moat is far more durable. It is a moat built from neural pathways. For surgeons who master the Da Vinci system, the console becomes an extension of their own hands. The requisite hundreds of hours of practice forge a deep-seated muscle memory, creating an ecosystem of dependence and consequently exceptionally high switching costs. The scale of this ecosystem is difficult to overstate. In 2024 alone, nearly 2.7 million procedures were performed using the Da Vinci platform. Each of these procedures serves to deepen the muscle memory of an individual surgeon and, in aggregate, strengthens the network effect across the entire hospital system. And this is the mechanism for indoctrination. SimNow is, in essence, a high-fidelity flight simulator for surgery. It allows surgeons to rehearse complex procedures in a virtual environment with performance measured by quantitative metrics. After a surgeon invests the 20 to 50 procedures required for proficiency, the cost, measured in time, cognitive load, and patient risk, of migrating to a competing platform becomes prohibitive. The fortress walls are thus constructed from validated expertise. We have examined the qualitative moat. Now we must understand how this strategic advantage is converted into financial performance. To do this, we must audit the numbers and analyze the financial architecture that sustains and expands this fortress. Observe the revenue trajectory. The expansion is both consistent and powerful. This is not the growth profile of a mature medical device farm. Rather, it reflects the platform dynamics of a deeply entrenched ecosystem, where growth compounds upon a growing installed base of systems. The composition of this revenue is of critical importance. This represents an evolution of the classic razor and blade model. The initial system sale constitutes less than a quarter of revenue. The true economic engine, fully 76% of the business, is derived from the sale of disposable instruments, accessories, and service contracts tied to each procedure. This creates a highly predictable, recurring revenue stream that finances the research and development necessary to continuously heighten the fortress walls. We have established the quality of the business and the robustness of its model. However, the quality of a business and the merit of its stock as an investment are two separate questions. To determine the latter, we must move from qualitative description to a quantitative audit of the company's intrinsic value. Our primary tool for this assessment is a discounted cash flow, or DCF model. The methodology is grounded in a core principle of finance, the time value of money. We begin by projecting the free cash flows the business is likely to generate over a discrete forecast period. We then discount those future cash flows back to their present value using a discount rate that reflects the inherent risk of the enterprise. This process allows us to calculate what the business is fundamentally worth to. Any valuation model is an expression of its underlying assumptions. Let us be transparent about ours. We project revenue growth of 14% annually through 2030, reflecting continued adoption. We employ a weighted average cost of capital, or WACC, of 9% to discount future cash flows. And we assign a terminal multiple of 35 times earnings, assuming the company maintains its status as a high-quality market leader into perpetuity. These are the inputs that drive our valuation. The output of our model yields an intrinsic value in the range of $445 to $475 per share. The market, however, currently prices the equity at nearly $530. This discrepancy is the central issue. The market price implies a belief in a future growth trajectory that is even more aggressive than our already optimistic assumptions. This premium requires careful consideration. The Fortress, however, is not a static entity. It is actively expanding its technological frontier. At the same time, the valuation premium it commands has attracted challengers. To assess whether this premium is justified, we must weigh a company's offensive innovations against the significant competitive and geopolitical threats now gathering at the gates. The company's innovation is relentless. The new DaVinci 5 platform possesses 10,000 times the computing power of its predecessor. This is not merely an incremental upgrade, it is a quantum leap in capability. This processing power enables novel features like force feedback, which for the first time allows the surgeon to digitally feel the tissue they are manipulating, a critical step in closing the gap with open surgery. For years, Intuitive Surgical operated in a competitive vacuum. That era has definitively ended. Industry giants such as Medtronic and Johnson & Johnson, entities with vast capital resources and deeply entrenched hospital relationships, are now fielding their own robotic systems. The siege is no longer a distant threat. It has begun. And the threats are not exclusively competitive. They are also geopolitical. This risk, disclosed in the company's own filings, highlights a significant vulnerability. A 25% tariff on goods imported from Mexico, where a significant portion of high-margin instruments are manufactured, would materially impact gross profit. This is an exogenous risk, entirely outside of the company's control. We must now synthesize these disparate factors. The formidable moat, the premium valuation, the technological innovation, and the growing threats. From this synthesis, we can construct a logical framework of potential outcomes for an investor over the next decade. We project 3 plausible scenarios. In our bull case, the Fortress holds. Market dominance is maintained, new platforms drive accelerated growth, and investors realize a 12 to 14% annualized return. In the base case, competition erodes some share, but market expansion allows for moderate returns of 8 to 10%. But in the bear case, the siege is successful. Competitors inflict significant market share loss, leading to margin compression and returns in the 4 to 6% range. And so we are left with a central question. The Fortress is built upon decades of accumulated expertise and a powerful recurring revenue model. The siege is now underway, mounted by well-capitalized and determined adversaries. Which of these forces, the inertia of the incumbent or the ambition of the challengers, will define the future of surgery? The outcome remains unwritten.